The American dream did not quietly disappear. It didn't slowly fade or gently decline. It hit a wall at full speed. What we are witnessing right now in the U.S. housing market is not a temporary pause, not a seasonal slowdown, and not a minor correction. It is a complete freeze. The latest housing data confirms what everyday Americans have already felt for months. Buyers have vanished. Sellers are stuck. Transactions have collapsed. In some major metropolitan areas, there are weeks where virtually no existing homes are sold at all. That is not how a healthy market behaves. That is what a system looks like when it stops functioning. For years, people were told that housing only goes up. They were told that demand would always exceed supply, that demographics would save prices, and that this time would be different. But markets do not care about narratives. They care about math. And the math has finally broken. Interest rates have surged to levels not seen in decades. Insurance costs have exploded, property taxes are rising, and the consumer is completely tapped out. Sellers are anchored to unrealistic prices from the peak, while buyers have been priced out entirely. The bridge between the two no longer exists. At the center of this collapse is affordability, or more accurately, the total destruction of affordability. Just a few years ago, the average middle-class family could stretch their budget and afford a modest home. Today, that same home costs nearly double per month, even though the structure itself hasn't changed. The walls are the same, the roof is the same, the neighborhood is the same. The only difference is the cost of money. Interest rates doubled, mortgage payments doubled, but incomes did not. That single imbalance eliminated most buyers almost overnight. When a market loses affordability, it doesn't slowly adjust, it locks up. Millions of Americans now fail the basic affordability test required to qualify for a mortgage. They are not irresponsible. They are not lazy. They are simply priced out by a system that moved faster than wages ever could. As a result, the only participants left in the market are those who don't need financing at all. Corporations, hedge funds, private equity firms, and ultra-wealthy investors are still buying. Everyone else has been forced to step aside. This shift is dangerous because housing is not just another asset class. It is the foundation of household stability. When families cannot buy homes, communities weaken, mobility declines, and economic growth slows. Ownership turns into permanent renting. And when shelter becomes an investment vehicle instead of a place to live, prices detach from reality. That detachment is now snapping back violently. The real spark for this crisis does not come from residential housing alone. It comes from commercial real estate, the quiet disaster unfolding in downtown America. Office buildings across major cities are hemorrhaging value. Remote work permanently changed demand, and companies no longer need massive office footprints. As leases expire, vacancy rates rise. Buildings that once symbolized economic power are now financial liabilities. These collapsing office towers sit on bank balance sheets. Regional banks financed them, using optimistic assumptions that no longer apply. As commercial real estate values crash, banks are forced to recognize losses. Their capital shrinks. Their risk tolerance disappears. And when banks panic, they tighten lending everywhere. Residential mortgages become harder to get, even for qualified borrowers. This creates a dangerous feedback loop. As lending dries up, fewer buyers can enter the market. As buyers disappear, prices fall. As prices fall, more homeowners slip underwater, owing more than their homes are worth. Once that threshold is crossed, behavior changes dramatically. People stop emotionally defending the asset. The house is no longer a dream. It becomes a burden. This is when strategic defaults begin. Homeowners who are financially capable of paying choose not to. They do the math and realize that continuing to pay a loan larger than the home's value makes no sense. They walk away. This is not a moral failure. It is a rational response to a broken system. It happened during the last housing crash, and it is beginning again. As defaults rise, inventory increases. As inventory increases, prices fall faster. Falling prices push more people underwater, triggering more defaults. This is the doom loop that turns a slowdown into a crash. Banks respond by tightening credit even further, which eliminates even more buyers. Liquidity disappears. Confidence evaporates. The market feeds on its own collapse. While most people focus on prices and interest rates, another major threat is quietly destroying housing from the inside: insurance. In high-risk states, insurers are pulling out completely. They are refusing to write new policies or dramatically raising premiums beyond what homeowners can afford. Without insurance, you cannot get a mortgage. Without a mortgage, you cannot sell your home. Entire neighborhoods are becoming effectively uninsurable, and a house that cannot be insured is functionally worthless in the modern financial system. No buyer wants to risk losing everything with no protection. The insurance industry is signaling that certain areas are no longer viable investments due to climate risk and financial instability. This alone can freeze markets indefinitely. Many still cling to the belief that low housing supply will prevent a crash. This argument ignores reality. Supply appears low only because sellers are locked in by ultra-low mortgage rates. They refuse to move because doing so would double their monthly payment. But life does not pause for mortgage rates. People lose jobs. People get sick. People divorce. People die. Forced selling is inevitable. Behind the scenes, a massive shadow inventory is building. Homes that are not listed yet, but will be. When economic pressure increases and unemployment rises, these homes will flood the market rapidly. What looks like scarcity today will become oversupply tomorrow, and markets move fast when sentiment breaks. Home builders see this coming. New construction is slowing dramatically. Cancellation rates are rising as buyers panic and walk away from contracts. Builders are offering incentives, rate buydowns, and upgrades, but fear is overpowering discounts. Housing construction drives a significant portion of economic growth. When builders stop building, the economy slows sharply. The Federal Reserve sits at the center of this disaster. Years of near-zero interest rates inflated asset bubbles across the economy, especially housing. Now, in an attempt to fight inflation, rates have been pushed high enough to crush affordability. The Fed is trapped. Lower rates risk inflation returning. Higher rates guarantee a housing collapse. The choice has been made. Short-term rental investors are another weak link. During the boom, thousands of people bought multiple properties expecting easy Airbnb income. Now, travel demand is cooling, competition is fierce, and operating costs are rising. Many investors are bleeding cash every month. They cannot sustain losses forever. When they sell, they will add more fuel to the fire. At the same time, millions of Americans extracted equity from their homes through HELOCs. They treated rising home values like free money. Those loans are now resetting at much higher interest rates. Payments have exploded. Many households are now trapped with two debts tied to a falling asset. This double leverage will drive bankruptcies. As prices fall, banks will protect themselves by pulling back lending even further. Credit will tighten. Even strong borrowers will struggle to get approved. Cash will become king. Institutional investors are waiting patiently with massive war chests, ready to buy distressed assets at deep discounts. For renters, this shift is dangerous. Falling prices do not mean easier ownership if credit is unavailable. Instead, more people are pushed into renting, while fewer corporations control more housing. Ownership slowly turns into permanent dependence. The psychological damage of a housing crash is enormous. Homes are the primary store of wealth for most Americans. When prices fall, people feel poorer. They spend less. This reverse wealth effect drains money from the economy, deepening recessions and destroying small businesses. The housing market is the engine of consumer spending, and that engine has stalled. Price cuts are increasing. Sales are collapsing. Fear has replaced optimism. This is no longer speculation. This is the early phase of a long correction. Housing crashes do not happen overnight. They unfold over years. The bottom is not here yet. Patience will be rewarded. Panic will not. A home should be shelter, not a lottery ticket. The financialization of housing broke the system, and this collapse is the painful reset. The bubble was the disease. The crash is the cure. Prepare accordingly. Reduce debt. Preserve cash. And do not bet your future on the assumption that housing prices only go up.